This is Alan Bush with ADMIS. In the stock index futures, we did see some new contract highs in the overnight trade in both the S&P and in the Dow futures. Since then, we have backed off a little bit. This after the non-farm payroll numbers coming in a little bit weaker than expected. Also, we had private payrolls coming in a little less than anticipated. Longer term, though, we feel that interest rates will remain low for a much longer period of time than most analysts are anticipating. And I think this is the fuel that will continue to support stock index futures through the rest of this year and well into next year. So the bull market still appears to be intact for stock index futures. Over in the currencies, we had the British pound falling to a 13-month low against the US dollar. This after the Bank of England making comments suggesting that interest rate increases in the UK will be limited and gradual. And I think that is in keeping with what we're seeing as far as other central banks globally, which are becoming a little more dovish, or those that are hawkish are becoming less hawkish. Also, we had the dollar index advancing to a 7-year high in the overnight trade, but backing off a bit with the non-farm payroll numbers coming in a bit on the weak side. We feel that in the next couple of weeks there is a very good chance, a strong possibility, that more Fed officials will voice criticism of recent gains in the US dollar. They have done that in the recent past, indicating that dollar strength could limit US economic growth. So with the dollar strong again over the last week or so, expect more Fed criticism of recent dollar strength. That could be the limiting factor that comes in to adversely affect the dollar index if more and more Fed officials are critical of dollar gains. Over in the interest rate markets, we did see a little pressure in the entire complex, with the 30-year bonds getting close to our major support area around the 140 level, and that would be in the December contract. Since then, we have seen prices reversing and headed higher. Longer term, with so many of the world's major central banks adding more reserves to their banking system, becoming less hawkish, we feel, how can the Fed by itself be the only central bank that remains very hawkish, even though the central bank now is projected to raise the Fed funds target rate in the third quarter of next year. Our feeling is they will not be in a position to do so. So look for the interest rate complex to remain well supported, with low rates likely to stay for a very long period of time. And once again, the 30-year bond should be the leader to the upside, and then I would be looking to be a buyer around the 140 area in the December contract of the bond futures. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.
I know.